Welcome to the Just Easy Options YouTube channel. Today we'll be discussing one of my absolute favorite strategies, the cash secured put. Now if you don't know what options are or what a put is, that is okay. I'll be describing it as I go along. But if this strategy intrigues you, make sure you click on the link above to my channel for more information on your questions. As always, if you find any of this information helpful, please like and subscribe. I'm new to YouTube, so it goes a long way. On the Just Easy Options YouTube channel, you'll get lots of videos as well as great YouTube shorts discussing different option terminology and trading strategies. So enough of the fluff, let's get into it. Cash secured puts. What are they and what do they do? My favorite way to explain this is as a limit order on steroids. As we know, a limit order is placed on a stock at a price that is the maximum you're willing to pay for it. So for example, if we wanted to buy Hood because we love Robinhood so much, but we don't want to do a market order because maybe it's trading a little bit above where we're comfortable picking it up. What we could do instead is place a limit order at say $53 per share, and let's say that we want to pick up 100 shares of these. This means that if Robinhood drops below that price of $53 per share, our order would get filled at $53 per share or cheaper. So at this moment, we are saving $82 by placing a limit order compared to a market order because Hood is currently trading at $53.82 and we're looking to buy 100 shares. But we are going to look at this in a different way because this is the Just Easy Options YouTube channel and we like to make money any chance we get. So what we can do instead is get paid to place this limit order. And this is what selling put option essentially is. So let's look at the option chain here. Now again, I said that we're selling a put option. And this is like doing a limit order on steroids. So we have a lot more factors in here. First is the expiration date. This is how long your order, or the proper term, contract, is active for. Personally, when I'm selling put options, I like to do them 1 week out, but this is completely up to you and how much management you're willing to incur. So let's stick with the 8/13 expiration date for this example. The second factor is the stock price, or the strike price, which is practically the maximum price per share that you're willing to pay for the stock. So just like the limit order, this put contract gives us the ability to buy the stock if it's at or below the strike price, which in this case is $53 per share. Now the last factor is the price of the contract, or proper term premium. This is how much money you'll receive for placing this order. So let me define a few factors here so that this makes complete sense to you. A put option gives the buyer of the option the right to sell 100 shares at the strike price on or before the expiration date. But what I'm talking about here is selling a put option. So that means that as a seller of this contract, we will receive the premium that was paid by the buyer, which means if the buyer of the contract decides that they want to sell their shares, they will sell to us at the strike price, which again is $53 per share. So moving on with this example, we can sell this $53 strike put on Hood expiring on 8/13 for $1.68. Now this price is a per share amount, and option contracts are always associated with 100 shares per contract. So this means that we'll get $1.68 per share. So that times 100 would be $168 per contract. Now if this price is not appealing to you, you can always change the expiration date or the strike price to maybe get something that's more desirable amount of premium for the price that you're willing to pay for Hood. So if we were to switch to maybe the August 20th date, you can see that this same strike would be $420 for the contract compared to the $168 that we were seeing on the August 13th date. So once we have settled on an expiration date, a strike price, and premium, we can add this to our cart, or I should say order form, and we can hit continue to adjust how many of these contracts we want to buy or sell, I should say, and fine tune the price we will sell them for. We can see that the bid here is 160, so if we wanted to get filled really fast, we can leave it or set it to that, or we can move it up to the ask price of 175 if we wanted to try to get some additional premium. But generally speaking, leaving it at the mid price is a good starting point, but you can actually enter in whatever you want here. But again, you'll only be able to sell this if somebody agrees to buy it. So don't go too far out from the spread shown here. So how exactly do we benefit from this? Well, there are two outcomes. Either the stock drops below $53 by 8/13 or it doesn't. If the stock does drop below $53, we will have to buy 100 shares of Hood at $53 per share, which is what we wanted to do anyways, right? Or at least we were willing to do that. That's why we opened the trade. In this case, we would then own 100 shares, and we would also have the $165 for selling the put option. That's why our break even is shown down here at $51.35. The other case is if Hood closed above $53 on 8/13. If that happens, this put would expire worthless, and we would get to keep the $165 and not be buying any shares of Hood, which is similar to if we just had a limit order placed and the stock never dropped to that price. Except with this, we get to keep the premium we received for selling the put option, which was the $165. Then, if we wanted to, we could just rinse and repeat and sell another one for next week and collect more premium. Now this probably sounds like a win-win situation, regardless of the outcome, right? Well, let's go over a few disclaimers before you start selling a bunch of these. First off, you need to have capital in your account to be allowed to do this. Robinhood, like all other brokers, require you to have enough funds in your account to purchase 100 shares of the stock at the strike price. And for this example that we've been discussing, that would be $5,300. The other important thing to note is as long as we hold this contract, we are obligated to buy 100 shares at the strike price if the buyer decides to exercise his right of the contract. So that means if Robinhood tanked in the next few days, say to $30, we would still have to buy 100 shares at the strike price of $53 if the buyer chose to exercise. And that would be a heavy unrealized loss. So please do your own due diligence and only sell these on stocks you're willing to own regardless of how much it drops. And as you can see, I don't actually have enough buying power to provide the collateral needed to enter this trade. But even still, there are other strategies similar to this that require much less collateral. For instance, there's the credit put spread strategy, and you can start selling those with only needing $100 to enter the trade. And I have some other videos explaining on how to do this on my channel. Also, if you trade with Robinhood with the mobile app, I do have a playlist dedicated to how you can enter these trades or enable option trading on the Robinhood mobile platform, so be sure to check those out. So that's it for today's video. Again, if you liked any of the information provided today, please like and subscribe. Leave a comment letting me know you care. If you have any interest in joining Robinhood or Webull, check out the My Card link below where you can get some free stocks for joining. I also have a TCWorks and Coinbase referral links in my bio if you're interested. Until next time, this has been Just Easy Options.